Well, welcome to the February 23 FMD Investment Committee update. As usual, I'd like to welcome my two guests today, Richard Dahl, who's the Principal Advisor and Chair of FMD's Investment Committee, and Mike Reynolds, who's a Director and Investment Committee member. Thank you both for joining us today.
Thanks, Lee.
Thanks, Lee.
Well, Richard, let's start with the start, and that is the data to the last 12 months to December 22. A pretty stark set of negative numbers.
A very difficult year, Lee, as we can see that it's about every asset class had a negative return and some had a very large negative return. So it was quite a difficult year, 2022.
Yeah. And so what was the main contributor to that, Richard?
Look, through COVID and coming as we went through COVID, interest rate settings were set at extreme low levels, interest rates. And while we expected that at some stage those interest rates would normalise, it's really the pace of returning to what might be a higher, more normal rate. We've got a couple of curves here that show you what we call the yield curve down from cash out to longer term bond rates in Australian Treasury yields. The bottom one, the dashed line back in the end of 2021, and the one above at the end of 2022. What we can see there is that the market was expecting that interest rates would rise from their extreme zero levels, looking at the longer term rates. And we were getting that message from the Reserve Bank, from the Federal Reserve, that we would have long-term low interest rates for some period of time. What actually happened was that later in 2021, the market started believing that interest rates would actually have to rise a little bit faster. And then into 2022, we had the big shock with Russia invading Ukraine, inflation coming, and the actual movement of interest rates happened much more rapidly than what anyone appreciated. And we see that second yield curve there at the end of 2022, cash rates at a much higher level and longer term bond rates at a much higher level. And all asset classes are, if you like, priced off those risk-free rates of return, and accordingly fell to the magnitude that you saw in 2022.
Yeah. So we saw a really big adjustment in investments, both defensive and equities, as a result of those unexpectedly soon interest rates.
Yes, indeed. Yeah. And sentiment was very, very negative. It builds on itself, and through late 2022, sentiment continued negative, so all market prices fell back. But
subsequently, Richard, that's changed significantly. If we look to January returns just on their own.
It did, and it's pleasing to see what happened in January. The green bars just in one month there, numbers through Australian and international shares, listed property trusts. We're looking at 4%, 6%, 8% in 1 month. We sort of say to ourselves, what happened there? Now, look, our last get together late last year, we explained to our clients that we had convictions in our positions, even experiencing what happened last year. There was a crowded trade into the US dollar when sentiment was negative, and the Aussie dollar was down at into the mid-60s against the US dollar. And we believed that having that US dollar, Australian dollar, was going to change at some stage, and so we increased the hedging. We maintain our conviction in shares and property trusts, and we said to our clients, it's a matter of when, if not if, that this would happen, perseverance. And in a moment, we'll talk about what happened in expectations of interest rates and a terminal, if you like, flattening of interest rates somewhere in the future. When that happens, Lee, markets, if like those trades reverse. Yeah. And now we've got more attractive asset class returns, and the trades were very strong.
So as markets can start to see towards the end of the interest rate rises, it starts to turn.
It certainly has, and there's a message for all of us there to maintain our conviction.
Yeah. Mike, if I can come to you, one of the key things I think we're looking to in terms of interest rate rises or the end of interest rate rises is inflation. If we look at inflation, we're starting to see that coming off in the US and in the Euro areas. What's the outlook for inflation? What do you think's going to happen?
Well, thanks, Lee. It is a challenging time for central banks because most central banks around the world have one mandate, and that's price stability. And I think I've mentioned this before. The US is different. So the US Fed has two mandates. It's price stability and full employment. So challenge that inflation remains persistent is as much around price stability, but also pressure on labour. Labour forces, wage negotiations, and those sorts of things. And a common theme, and I think everyone here in Australia has seen it, you go to a restaurant and help wanted everywhere. So there's just a shortage of labour across the Western world. And it's not immune to just Australia. It's clients I talk to in London, it's the same scenario. Clients we have in the States, it's the same. So there is a post-pandemic, there has been a massive disruption in the labour force, and I don't think anyone's particularly clear as to why. It's a combination of immigration decisions where governments lock down countries to cross borders, so you quite often had a lot of migration, and particularly foreign students too here in Australia have a big part to play in in employment in restaurants and hospitality, which we've seen. So it's a bit of a preamble, but the most important thing is in America, and maybe if we go to the slide around the employment numbers for last month in the States, the market had expectations of the number of new jobs to open was going to be 300,000 and ended up being something like 550,000 jobs created, or 517,000 in the month of January, which was miles more than what the market expected. And so when there's a shortage of labour and there's lots of job openings, so in America there's roughly 1.6 jobs open for every one person that's looking for a role, you have pressure on wages, you have pressure on negotiation, and that persistence of those cost pressures in business flow through to persistency in inflation. And that's why the Fed is adamant that they need to be really hard on trying to curb demand, and the only thing they have is monetary policy, and that's why we've had this rapid rise in interest rates, trying to slow down those things. And the challenge is, how far do they go? We think, from our point of view, we think that we're much closer to the end of the interest rate tightening cycle, although I think the difference between Australia and the US will be different. I think our terminal interest rate rise here in Australia will be lower than the US. But we're not out of the woods yet. We are much closer to the end of the cycle, but I think we've still got a few months of uncertainty to go. Richard,
if I come back to you, the portfolios, you've talked already about the conviction we had in our positioning prior to this rally in January. How's the IC positioning portfolios at the moment? Are there changes or what's happening at the moment in the portfolio?
Lee, look, we've remained comfortable with the portfolio positioning. Having said that, it's been a pretty difficult year in 2022. So what we have done is review those positions with our consultants to ensure that they remain the right settings, as well as all the underlying managers have had reviews by Zenith and by Caravel to make sure that those managers are maintaining their conviction as well. It's a really important thing. And so the investment committee has been through and met all those managers a couple of times through 2022, and we continue to do that in 2023 to make sure that they're holding the position, because what we want to do is make sure that we participate in the rallies. So our last couple of meetings that we've had, the investment committee meetings, have been around, are the settings right to take us through the rebound, which is ultimately coming? And we're seeing some green shoots of that in that chart.
Yeah.
So answer to your question, as far at the moment, we are not making any changes to the portfolios. We think the valuations still remain attractive through shares where we get, and real estate trusts where we'll get our greatest rebound, and we'll start seeing returns come from there. So it's really holding our position.
So strategically, we're effectively targeting our strategic asset allocation benchmark for each asset class?
We're actually sort of slightly overweight Australian and international shares.
Yep.
We still maintain, even within those asset classes, what we call exposure to growth. We have a reasonable balance between growth and value, traditional valuation stocks, but we're still maintaining that. We're still maintaining what we'd call probably a bias more to sort of growing companies with middle-size, smaller-size companies that will grow. They've had a bit more volatility through last year, but they also sort of remain quite attractive. So compared to our long-term benchmark, slightly overweight. Now, the other thing, what we're seeing, Lee, is in the portfolio is we did make a change last year to introduce a bit more interest rate duration. And we're seeing a lift in portfolio valuations. And in fact, when we talk to our consultants, they're talking about sort of, if you like, higher expected returns across all portfolios as we get that lift through from that fixed interest sector particularly.
Yeah. Yep. And currency-wise, where are we sitting there? Our international exposure hedged, fully hedged, half hedged? Where are we sitting?
We've been sitting around 70% hedged. And a 50% hedge ratio is one where you really don't have super conviction whether the Australian dollar is strong or weak relative to the US and other currencies.
Yeah.
So we remain conviction that we think the Australian dollar will strengthen from here, but it is quite volatile. We saw it at 71.5 cents. Recently, it's down to 69. We expect that we'll get a little bit of increase in against the US dollar as the outlook improves.
Great. All right. So in terms then of our positioning, we've got strong conviction that there will be a recovery. It's just a question of how long the bumps in the road are with the inflation ups and downs and interest rates responding. Mike, is there anything else you'd add in terms of positioning or IC sentiment before we wrap up?
I think, we talked about inflation. I think last year we sort of said to clients that at the point in time that central banks changed the message that they've done with raising interest rates, markets will feel much more comfortable about that. And I think what you've seen in January is the expectations of a hard landing at the moment has got a bit more conviction that that things are not that bad. And you've seen earnings season in the States thus far reasonably good, and same here. Borrell reported yesterday their numbers were good. Suncorp had a good year, and so the expectations around market behaviour and the end of the interest rate tightening cycle that's where we've got to. And as long as that remains on track and inflation numbers, don't get worse, then I think the back half of this year, markets will feel a bit more comfortable as long as the interest rate tightening cycle comes to an end. If that doesn't, then we'll have to reconsider our options.
But signs are at the moment that it will.
Absolutely, yeah. I mean, I think that, and that's the base case where the investment committee sits. We think that the rate tightening cycle is close to finishing here, and that will be a much better environment for investment markets.
Great, thanks, Mike. Richard, anything else to add before we wrap up today?
No, I mean, obviously with interest rates rising and getting the tightening cycle, we have seen mortgage rates increase, and that's a sort of it's a tougher position for a lot of people with higher mortgage rates. But what that does do is it curbs spending and demand, and that's all part of interest rate expectations, Lee. So that's a real thing.
And as we know, that'll have a much bigger impact in Australia than it might in the US at this point.
Yes.
On housing repayments, yeah.
Yes,
absolutely.
Yeah. All right, gentlemen. Well, thank you very much for your time today. Thanks for updating our clients on the positioning of the AMS portfolios. We'll look forward to joining you at the end of March, and hopefully we've got some more positive news.
Thanks,
Thank you.
Lee.